For the past decade, the dominant strategy for building a financial technology company was asset light. Build an app, acquire users quickly, and rent a license from an established institution. This model is now fracturing under its own structural weight. This table displays Green Dot Corporation's financial metrics for 2025. Green Dot pioneered the practice of providing banking as a service to fintechs. But despite growing its revenue to over $2 billion, the company posted a severe GAAP net loss of $98.9 million for the year. GAAP stands for Generally Accepted Accounting Principles, the standard framework for financial reporting. The costs of regulatory compliance and technology migration simply outpaced their partner revenue. Now look at the right side of this chart. Nubank is valued at nearly $79 billion, and Revolut sits at $75 billion. These companies do not rely on third parties. They hold their own full banking licenses. The practice of renting balance sheets from smaller sponsor banks has reached its economic limit. The largest players in the industry are abandoning the partner model entirely, actively securing national charters and specialized regulatory authorizations. This transition towards institutional sovereignty gives firms direct, unmediated control over customer deposit bases, settlement payment rails, and the business's core unit economics. To understand the logic behind this shift, we need to deconstruct the mathematics of the banking core and map the regulatory hurdles required to build these modern financial empires. Success for the next generation of fintech relies on a full banking license, the foundational requirement for building a scalable, profitable, and resilient global institution. The push for full banking charters comes down to a single economic objective: optimizing the cost of funds. This equation calculates the net interest margin, or NIM. It measures the difference between the interest income generated from assets, like loans, and the interest expense paid out to liabilities. For non-bank fintechs, the cost of funds is dictated by wholesale warehouse facilities provided by larger banks. These credit lines are priced at a premium above benchmark rates and are highly sensitive to market volatility. Securing a bank charter changes the equation entirely. As the cost of funds variable swaps from the expensive warehouse rate to the rate paid on customer deposits, the numerator expands significantly. Deposits are generally the lowest cost source of capital available in the financial system. SoFi Technologies demonstrated the power of this mathematical shift in 2022 by acquiring Golden Pacific Bancorp to secure a national bank charter. By moving their loan originations off warehouse lines and onto their growing deposit base, SoFi dropped their average cost of funds by up to 217 basis points. A basis point is a unit of measure equal to 1/100th of 1%, used to denote the percentage change in a financial instrument. That single variable swap translated into more than $500 million in annual interest expense savings. While traditional banks saw their lending spreads compress under broader market pressure, SoFi leveraged this structural advantage to defend a high 5.8% net interest margin deep into 2025. Management refers to this engine as the financial services productivity loop. They acquire customers cheaply through high-frequency products like checking and savings accounts, and then use those low-cost deposits to fund high-margin lending products like personal loans and mortgages. For high-velocity lenders, successfully executing this charter transition determines whether the company remains in perpetual cash burn or achieves structural GAAP profitability. While lending platforms need charters to gather deposits, payment and infrastructure specialists are pursuing specialized, narrow charters to control the underlying settlement layer. This flowchart maps a traditional cross-border payment. The transaction hops from the fintech to a BIN sponsor through multiple correspondent banks before settling at the central bank. Every intermediary introduces severe friction, adds significant processing latency, and heavy added cost. Companies like Stripe are actively collapsing this chain. By obtaining a limited-purpose bank charter, Stripe bypassed the BIN sponsor entirely, securing direct membership with the Visa and MasterCard networks. Wise is taking a similar approach for cross-border money movement.
They have applied for a national trust bank charter to eliminate corresponding banks and settle U.S. dollar payments directly. That charter grants them direct access to the ultimate settlement authority in the United States, the Federal Reserve. Stablecoin issuers are following suit. Circle has applied for a national trust charter to hold the reserves backing its USDC token directly at the central bank, rather than parking those funds at commercial institutions like BNY Mellon. This structure is known as a narrow bank. Unlike a traditional bank that lends out customer deposits, a narrow bank holds 100% of its reserves in highly liquid, safe assets, eliminating the duration and credit risks of fractional reserve banking. Connecting straight to the central rails means transactions settle faster, fees drop significantly, and the company insulates itself from the systemic vulnerabilities of partner banks. For these infrastructure providers, specialized sovereign charters act as aggressive tools of disintermediation, designed to permanently sever legacy correspondent banks from the digital value chain. But sovereignty comes at an immense cost. Banking charters are intentionally designed to function as massive, capital-intensive barriers to entry. Regulators are formalizing these structural moats globally, highlighted by the enactment of the United Arab Emirates' new banking law in 2025. In the UAE, a startup can test a product in a regulatory sandbox with just a few thousand dirhams. But to operate as a full specialized bank, the law requires 300 million dirhams in irrevocable, unconditional paid-in capital. Alternative pathways exist within free zones like the Abu Dhabi global market, mandating a base capital of $10 million for full deposit-taking operations. The United Kingdom utilizes a different kind of barrier known as the mobilization phase. This framework grants restricted authorization, severely limiting a new bank's operations until it can prove systemic safety to regulators. Revolut serves over 45 million customers globally, yet they remain trapped in the UK's mobilization phase for nearly 20 months before securing full authorization. Regulators demanded a total administrative re-engineering of historical financial audits, requiring rigorous proof that Revolut could safely manage risk across its massive international footprint. Successfully exiting mobilization requires completely abandoning the traditional software ethos of moving fast and breaking things. It demands the implementation of a highly rigid, fit and proper institutional culture. These extreme compliance burdens and steep capital minimums act as a deliberate competitive shakeout, ensuring that only the most heavily funded, deeply organized entities can cross the moat into sovereignty. This mass migration leaves legacy sponsor banks in a precarious position. The institutions that thrived during the asset-light era are now seeing a mass flight to quality. Facing a surge of regulatory enforcement actions related to anti-money laundering and third-party risk management, these sponsors are being forced to aggressively shrink and carefully curate their remaining fintech partnerships. The industry-wide reconfiguration was perfectly illustrated in late 2025 with the privatization and splitting of Green Dot Corporation. To survive, the company had to physically separate its high-growth technology arm into a private entity, legally isolating it from the capital-intensive, highly regulated banking arm. For the thousands of smaller fintechs unable to afford a charter, the sudden disappearance of willing sponsor banks effectively closes their operational roadmap. The companies that have successfully secured their licenses are looking toward the next frontier, Agentic finance. In this model, intelligent software agents go beyond managing user interfaces and actively optimize the underlying balance sheet. These chartered entities are now using their principal status to bridge traditional finance with decentralized protocols. New laws, like the UAE's Law No. 6, specifically permit licensed banks to act as regulated custodians for tokenized deposits and stablecoin assets. Traditional banking incumbents now face direct competition for deposits and lending from technologically superior, fully chartered peers who operate with a more efficient cost structure. The integration of agile software into the regulated core of a banking charter defines the permanent architecture of the digital economy.